Hey everyone, Marty Mazzora here. Good morning. The 7th of August, 2019. I've been seeing a lot of hits on video blogs lately, so I think I need to come at you with these a bit more frequently, and I'll keep them relatively quick. Won't show you everything we look at on the charts, but I'll show you what I think is important for the moment, and then of course we'll mix it up. And so this is the S&P 500 futures chart. So this is live. This is another thing we track on an ongoing basis, especially outside of regular cash trading hours, because futures trade virtually all the time. Developments since yesterday in the futures market has been interesting. That real nice bounce yesterday, but it seemed like almost immediately futures began trading lower. And it looks like they bought around 8 p.m. yesterday evening, and then they turned higher. In fact, futures were trading nicely in the green right up in here, which would be about 2 a.m. this morning. And when I'll wake up frequently overnight, I'll just take a quick look. And I did see a tweet from the president talking about South Korea conceding on something as it related to North Korea. Really wasn't a lot of anything in here though that would suggest that the market should be rallying like crazy. And then you kind of go back to sleep and you wake up and we are having a precipitous drop in futures right now. In fact, if the Dow were to open right now, it'd be down 360 points, and the S&P is down a bunch, over 1.5%, which is 44 points on the S&P. Looking at Twitter, good or bad, that's where you get the fastest news. The president has got a raft of tweets where he's really attacking the Fed. And he says, this is not about China, it's about our Fed. We're competing with the rest of the world and they're lowering interest rates and our Fed screwed up, they don't know what they're doing, so on and so forth. Well, folks, I hope you realize by now two things. Number one, we're not political here. We tell it like it is. And number two, what the president just tweeted is just completely at odds with reality. Problem is the trade war between China and the US and the huge disruptions. He tweeted this morning that companies are leaving China by the thousands. Now, I can tell you in a global marketplace, like it or not, that's the marketplace we live in. The second largest economy, losing producers by the thousands, is bad for all of us. If indeed we're concerned about the strength of the global economy, especially the largest economy, which of course is us, and the strength of global supply chains and the norm. Again, for some reason, not sure why, but for some reason, in fact, I do know why, but for some reason, globalization has kind of become a bad word. Well, it can be a bad word, but if we deny the fact that in this world we live in today, the growing populations are really where companies need to focus. And that in nations that evolve from subsistence levels into more dynamic economies are going to grow at multiples of the pace that advanced nations do. They're also going to capture the low-wage manufacturing jobs, while advanced nations capture the high-wage technology and services jobs. For a developed nation to try desperately to go back to generating a large labor-intensive manufacturing facility, if you will, is indeed going backwards. That's not the direction we want to go. But politicians, right and left, have always been good at harnessing it. Quite frankly, up until the present administration, it's really been the left that's been more populist-oriented and more protectionist-oriented. So that creates quite the conundrum. The other thing the president is saying this morning is the Fed needs to aggressively cut interest rates. Folks, I'm here to tell you interest rates are plenty low enough right here, especially if the economy isn't in recession just yet. If the Fed were to jump in and just lower interest rates to nothing like other countries are, I think we would have an epic bear market, because that would tell the world that the US economy is in huge jeopardy. That would be the Fed desperately trying to support an economy that's already in recession. That would be the signal, and that would be the effect. You might get a day or two or three bounce. We had a nice bounce yesterday after that big decline on Monday, and we could bounce again today. This volatility is not what concerns me. What concerns us is the underlying data, the environment in which companies operate under. And that is deteriorating quickly. All the Fed could hope for would be, and this is what I think the president hopes for, is that they boost the stock market and they boost asset prices. The problem is the US, China, the US, and the rest of the world, protectionism in general, populism growing like crazy in the rest of the world. Polls over the weekend showed a populist anti-immigration, anti-trade movement is doing really well in the German polls. And that has German sentiment among investors and the smart money really beginning to roll over. So anyway, so I'll get off that soapbox. Right now, we have a market that is under pressure. Um, there's no smart market players that believe the Fed is the problem. The Fed could bolster things up. They could bring the market up, but they're not going to bring companies back to engaging in capital expenditures and growing their businesses. None of this is going to help. None of this is going to fix the problem. My concern is it might even exacerbate the problem because it emboldens the folks who want to keep this trade war alive. So that kind of denial on the part of the president isn't healthy. I think that there probably is what precipitated this real acceleration here in futures to the downside. Something is happening as I speak as we get close to the open. As you can see, we're getting a few points increase here in S&P futures. Right now, the Dow would open down about 323 points. When I first started talking, it was about 360 points. And the S&P has regained about 10 points, which we're seeing in here. Still a very ugly open is what we're looking at in about 9 minutes or so. Okay, so I said I wouldn't keep you long. Let me zoom out. I'm going to zoom out just a bit here and go all the way out to the one-day chart. You know, here's where we broke down out of that wedge that I virtually promised you we would have, because that's what happens when we get into longer term or even shorter term upward sloping wedge patterns. They're just really bearish patterns, and you can see, you know, the breakdowns below these, right? And then this one was pretty stubborn, but boy, did we get a nice big drop coming out of that. We had this huge candle on Monday. We got the nice technical response. Notice you'll find all over the place big red candles, right? With you know, nice green candles to follow. And here we had actually several days, and I think this could happen here, where we had a nice bounce. We came back up to this level and then rolled over to a pretty good little correction here in May. You know, here, nice big red candles, 3 in a row. Nice run back, tested this prior support level. Big candle, green candle, red candle, came back, tested the support level again, and then rolled over to into the worst December since 1931. By the way, right here, tweet, I'm a tariff man. And that was all that she wrote in a December, which is a month that lacks liquidity. Then we got the nice bounce, got a lot of good talk on trade in here, built some momentum, and then up in here, same kind of thing, folks. It's I posted the other day, I kind of showed you the chronology of these declines. Every spot, every single spot right before the rollover, there was aggressive rhetoric toward global trade. That's the problem, and that's what's killing the data underneath the surface and has me really resorting now to much more of a preservation mode than we've been in a long time. I want to show you the volume. Notice the trend in daily volume on S&P futures. Notice as the market was falling, look at the volume spiking higher. What does that say? The bears have conviction. The bulls do not. Momentum, remember the MACD, rolling over all the way from back here, losing momentum. The relative strength index, flat to down, losing momentum. On balance volume, looking promising in here, but rolling over. Waiting and hoping for cooler heads to prevail. We get something along the lines of a tweet that says, I just got off the phone with my good friend G. We are going to meet and we are going to get on better terms, and we're going to begin unwinding all of this pain that we put the global economy through. Of course, it's not going to be couched that way. But if that's the signal, I think this market can rocket higher. I think animal spirits can still come back. I think these negative technical indicators can resolve higher. And I think that we can get what we need. And that's another couple of years of expansion, because this Fed at these interest rates is in no position to do business with the next recession that comes soon. We need some inflation. We need higher interest rates. We need that last bit of kind of frothy growth in the economy. We need the Fed to combat that with higher interest rates. Then they're in a position to do something with the next downturn. Underneath the economy, I see some issues. Some of you, I've shared that with you on an individual basis. I'll probably begin to share more of it on the blog, but there's some real concerning stuff out there when I dig deep into the internals of the global economy. One of them is just where the corporate debt lies right now in terms of credit quality, and what would happen if we started seeing corporate credit ratings become downgraded, and what would happen inside of pension funds and so forth with that lower rated corporate debt. So I'm hinting there that there's a real under the surface problem that really isn't a problem as long as the economy is in good shape. But once the economy isn't, that could bleed into something quite pernicious. So I'm going to plead one more time to you clients out there. Many of you have responded and we're getting to work on your portfolios. I don't want to get markedly defensive with the allocation, have the trade war go away and watch the market run away without us. I do want to put an options hedge on every portfolio that's big enough to hold it. A bunch of you have received 2, 3, 4 emails from me. We're having to do it in that fashion because each portfolio takes quite a bit of mine and Nick's time tweaking it to where it needs to be and then putting on the collar. So we literally cannot do long conversations explaining it all. Nick put together an excellent video that complements the real basic one that I put out here two, 3 weeks ago. But his really answers the questions in terms of the mechanics of how an options collar works. And I literally sit with the portfolio. I tweak it right to where I need it to be and so forth, create the cash that's needed to back the collar and all this kind of stuff. And then he applies them to all the portfolios that are ready to go that day. It takes a ton of time and effort. So I need you folks who are now watching this, who haven't been paying attention, to go back to those emails. I'll send another one out today. Watch my video, watch Nick's video if you need to, and then immediately reach out to me via email and say, Marty, we're ready to go. Send us the options paperwork. Once we have that on your account, then we don't need to do this again. But right now, we need your approval to put options on there and go ahead and put the collar on your portfolio. You'll see in my video and Nick's video what all of the ramifications are. Thank you, folks, as always, for watching and listening, and I will be back often. Take care.